Is the bloodbath in the stock market over, or has it just begun? Depending on who you ask, you're going to get very different answers to that question. Many people are saying, hey, we've got the biggest stock market crash in history still in front of us. We've got another 70, 80, 90% to go down from here. While at the same time, you've got other investors saying, hey, we've got great deals available in the stock market now. Many of these stocks down 70, 80, 90% from their all-time high just a year ago or 2 years ago. Fantastic deals that investors should be taking advantage of right now. So in this video, we are going to look at both sides of the coin. We're going to put the evidence against each other, see which side comes out on top to give you the most education and the most information possible to make an educated decision on where to invest your money right now, or still holding back your cash on the sidelines for better deals later on. Ready? Let's dive in. Today's sponsor is MooMoo. If you haven't heard of MooMoo, they are my new favorite app for advanced investors and traders. So who are they? Well, number one, MooMoo is a NASDAQ listed company. They are founded in 2018. They're basically a fintech company, and they have now more than 18 million users from all around the world. Their market cap is just about $7 billion. And the reason why they've been able to grow so quickly and attract so many users from all around the world is because of the free access to some of these advanced tools that many other platforms will not give to you. And that honestly is the reason why I like MooMoo. They're democratizing access to these professional level trading tools, making them available to individual investors. One of my favorite tools that they give you access to is Level 2 data. You can see I've got it pulled up right here. Level 2 data gives you access to see the market depth. And so you can see this green side on the left and the red side on the right. Those are all of the outstanding open limit orders there. So you can see this is especially useful on a security that is low volume. You don't want to just go throw in a market order and hope for the best, hope it doesn't move the market. With Level 2 data, you can see where open orders are sitting so that you know where to place your orders so that you don't move the market, how many shares to buy or sell depending on what the liquidity is at that moment. You can see it right away here with this Level 2 data. You can see that market depth, absolutely essential tools. And my other favorite tool that they have is the ability to track institutional portfolios. If you see here under markets, you go to institutional tracking, you can see some of the large institutions that they track like Berkshire Hathaway, Soros, you can even go into Bridgewater. So let's go there. And you can see right here that they list the top buys. Right now it's Medtronic, Berkshire Hathaway, Caterpillar. You can even see their top holdings lists. And when you scroll over, you can see how large that position is in their overall portfolio. Absolutely powerful tools here again that they're making available to individual investors. You can follow the big money, copy the big boys, and just ride that wave. So I like MooMoo, and if you use my link in the description below to sign up, you can get 5 free stocks worth up to $2,500 per share. Sign up for MooMoo using the link below today. All right, so is the stock market headed upwards for here, or did we just get a 1 month rally and now we're on our way lower? Well, you have to take a look at a couple things. Number one, consumer sentiment. This measure of consumer sentiment shows that it is absolutely in the dumps. People think everything is worse than it's ever been. You can see as far back as this data goes. Now, if we look at the stock market, it hasn't fallen that much, right? And so we can measure here from the top, this is just the S&P 500, to the bottom, we've fallen just about 25% from the top there, which is not crazy. I mean, we've had much larger drops than that in the past, but many are saying that we should go much lower from here. The other thing that I want to do on this chart is look at the channel that we're in, because yes, over the last month, we've headed higher, right? We are up about 10% from the bottom, right? Yep, just a little over 10% from the bottom there. So that's a good rally, and many people are thinking, oh, the worst is behind us. But if we take a look at this longer term channel that we're in, yes, the last month we've been in an upwards channel, an upwards trend. But when we take a look at this longer term trend here, basically we were just bouncing from the bottom of the trend to the top of the trend, and we've been doing that since since the beginning of this year, bouncing in between the two. So you would want to be bullish when you hit the bottom of the trend, then you'd want to get bearish again right when you get towards the top of the trend, right there, here, and right here. Could we head higher and break out as a false breakout like we did here? Of course we could. But the fact of the matter is we are still in this downward trend. We are over 20% top to bottom in a downwards trend here. That is a bear market, which technically speaking means that this 10% rally is a bear market correction, because a correction is just undoing something in the longer term trend. So if you've got a bull market and then it goes 10% down, that's a correction. That's bringing it back down to normal levels before it resumes its upward trajectory. But when you go 20% down or more, now you've entered a bear market. You're no longer in a bull market. So a 10% move up from the bottom during a bear market would classify as a bear market correction. So it's not that the bear market has ended, it's just that the over bearish sentiment there, it was kind of extreme, so it's corrected upwards, and now we would resume our downwards trend. So that is something to be concerned about here, that we've kind of reached the top of this trend. We've been going up for a month. Meanwhile, all economic indicators have been getting worse and worse and worse. And that's why we see some charts on this article from Bloomberg I want to show you, showing some extreme bearish sentiment still. So number one, we're going to look at from fund managers, their equity allocation versus bond allocation. So we can see here that right now, outside of March of 2009, this is the lowest equity allocation compared to bonds that we've had since this data started in 2000. So that is a very bearish indicator there. The reason why this is bearish is because you have investors saying, hey, we'd rather lend money to the government at a rate that is below the inflation rate. And so we take a guaranteed loss because the potential losses by investing in equities are so much larger in our opinion. So that's pretty bearish on the economy. The next chart that I want to show you here is this one. This is the percentage of funds taking higher than normal risk levels. And you can see we're actually surpassed October of 2008. So the number of fund managers saying we're going to take higher than normal levels of risk, there's like none of them right now. They're all pulling back on their risk. They're being very conservative. Now, one thing that I want to point out though, yes, that's very bearish, but let's go on the chart here back to 2008 here. And let's go to that October timeline there. Back in October, the stock market was right here. So were we done selling off? No, we had a couple more months until February or March of 2009 where it bottomed out. If we measure that from October here, the highs there to the low, we had another 30% to go down. So that is significant. But when we zoom out here, that was pretty darn near the bottom, right? So any investors that piled in right here starting in October when sentiment was like the most risk off, was the most risk averse. Yes, they took a hit for a couple of months, 6 months, but that was still a really good time to buy in historically, and we haven't reached lows anywhere near there since. We've just been going up and up and up and up. So that's an argument on the other side here. While yes, it looks like we do have another leg down, and we could go from here another, let's say if we do a repeat, another 30% down would take us all the way down here to 2,800 on the S&P 500. Absolutely, we could do that. But if history repeats itself, then that would indicate that even buying in at the levels we're at right here would be relatively low looking forward into the future. That yes, there's a dip down, but we're going to rally up much higher than that into the future. So that is one thing to take into account. And then finally, I'd like to take a look at one last chart. This one was posted on Twitter. This chart is from Stifel. And you can see this, basically what's going on here is this red trend line shows where the Federal Reserve normally pivots. And this would indicate a bottom in stocks, that every time you start to see the economy taking a hit, real yields start to spike, it causes pain, then the Fed pivots and everything gets easier and things start going up from there. And this is where I think the rubber hits the road, because over the last 30, 40 years, we've seen an over-financialization of our economy where now it's basically all one trade. And if the Federal Reserve continues to tighten, we've got a lot more pain ahead. If they start to ease, we can take that as a sign of reversal in the economy, because you start pulling money out of an economy that is built on the highest pile of debt in history. Well, things are gonna get painful. Things are gonna start to hurt. Things are gonna start to collapse. On the other hand, if you start to add money back in to that economy, well, then it makes that debt service cost easier and you have more money to chase around the same number of assets and goods and services. That pushes prices higher. And so the rubber hits the road here when we look at inflation. At all these times, in 2006, in 2018, even before that, every time the Fed has pivoted, the CPI was nowhere where it's at today. Nowhere near where it's at today. And the Federal Reserve understands this. Maybe not to the extent that you and I would prefer, but they know right now their number one goal is to get inflation down, to get inflation lower. That's why they've been increasing the rate at which they've been increasing interest rates, because they know they've got to get a handle on it. Otherwise, you risk the currency tipping over into a hyperinflationary collapse. And that's the last thing they want to happen here. So they know they have to put the brakes on there with how easy monetary conditions are. And so if inflation stays elevated, we're not going to get that Fed pivot like we have gotten in the past. Now, if we get demand destruction in the next couple of months, unemployment, layoffs, people stop spending money, prices start to collapse, the CPI goes down to 3%, even 4%, my bet is then we would have the ability for the Federal Reserve to say, hey, we're maintaining our confidence in our abilities and we're going to now pivot because we brought inflation down lower. It's possible. Who knows at this point what will happen, but we have to keep our eyes on the Federal Reserve because again, like I said, it's all one trade now. We're not going to get that Fed pivot as quickly as we've gotten in the past because inflation is not where it's been at in the past. Inflation is much higher. So once we get that Fed pivot, it's probably smooth sailing in terms of asset prices. However, without that, I think we probably do have more pain ahead regardless of what some of these fund managers are doing, what the sentiment is saying, what the charts are saying. My eyes are on the Fed. Let me know if that makes sense. If you have any questions in the comment section below. And as always, really appreciate you guys. Thank you so much for watching. Have a great day.